Let's talk debt. The topics we will cover today are: what is debt? Is debt or good or bad? What is a debt to income ratio? Being in debt versus having debt. The advantages and disadvantages of the most common forms of consumer debt available to us. 4 strategies you can use to create a debt payoff plan that works best for you, yourself, and your situation. How to stay motivated if debt payoff is one of your financial goals. So debt, it's a word which often has a negative connotation, as there are many stories of how individuals with too much debt have experienced financial ruin or close to it. However, if managed properly, debt can often be a good thing in our financial lives. An acceptable low interest rate, for example, such as those found on mortgages, can make debt manageable and acceptable. On the other hand, high interest rates, such as those found on credit cards, can often lead to debt levels spiraling very quickly out of control. So like most things in life, a moderate amount that is carefully researched, monitored, and within your financial means can be the right level of debt for you. And for some people, that is zero, no debt. For others, an acceptable percentage of their stable income is okay for them. So what is considered an acceptable amount of debt? It very much depends on factors such as what stage of life you're at, your spending and saving habits, the stability of your job, your career prospects, your financial obligations, but also your mindset when it comes to having debt. But first, let's discuss what is debt. So what is considered debt? In its simplest form, it is an amount of money owed or due to another person or an entity, such as a bank or a credit union. Examples of common debt are credit cards, bank overdrafts, personal loans, car loans, mortgages. But even unpaid bills such as electricity or phone bills are forms of debt. So is debt a good or bad thing to have in your life? Many believe no debt is good debt. And there are merits in that belief, absolutely. The definition of good and bad debt but will vary per person and their personal situation and very much on their money beliefs. Good debt is often defined as money owed for things that can help build wealth or increase income over time, for example, such as mortgages for a home or an investment property, student loans, or a business loan. Bad debt, on the other hand, refers to things like credit cards or other consumer debt that do little to improve your financial situation. Many consider debt to purchase assets such as cars as bad debt in this example. But debt is not just about the numbers. It can be a very emotional subject. For example, having any form of debt causes you to worry and add stress to your life, then potentially all debt is bad debt in that sense for you. On the other hand, if you have debt such as a mortgage, which allows you to buy a home that you love, it doesn't keep you awake at night just by having that debt, and your debt to income ratio is below 30%, then this may be considered a good debt for you. The key is to know the numbers, but also know yourself. So what is a debt to income ratio? Debt to income ratio measures the amount of debt a person has compared to their overall income. So for example, if your monthly debt payments are $2,000 and your income is $5,000, then your debt to income ratio is 0.4 or 40%. Debt payments incorporate all debt, such as your mortgage, any credit card payments, and all loan repayments combined. So my recommendation is your debt to income ratio should never be any more than 0.3 or 30%, and even less if that debt doesn't include a mortgage for a home. Lenders will calculate this ratio when assessing your application for a loan, for example, and the lower the current debt ratio, the more likely the bank will lend to you, and they may even offer you lower interest rates because you have a low ratio. Now, being in debt versus having a debt, and is there a difference? So what is the difference? For me, the two phrases describe two different situations and also different mindsets. I believe being in debt means you have debt which hinders your life, are not income generating, and possibly too much of your income is going towards debt repayments every month. Potentially, you are unable to pay your debt commitments, they're causing you major stress, and they are growing rather than shrinking each month. A very common example of this would be not being able to pay off your credit card each month, and therefore it's growing in balance. Having debt, however, is when we have debt which is within a healthy debt to ratio range. Example, a mortgage on your home which is just 15% of your monthly salary, or having a balance due on your credit card, but you have more cash in your current account than is due on that card, so you can pay it off in full at any time. An example of this is where I use my credit card for all purchases, but I never go above what I've budgeted, and most importantly, I don't spend more than the cash available in my current account. This way, I get the convenience of using a credit card, I can easily track how I'm spending my money, plus I get points which accumulate and I can use towards flight costs or redeem in stores to buy sometimes expensive, unexpected items. An example of this was recently where my children needed iPads for school. With 3 children, that's a lot of cash I didn't expect to have to pay out all at once. Fortunately, I make my credit card work for me, and that meant I could pay for them with credit card points. To me, that is a good use of debt. However, it is crucial to highlight, and please understand, I always pay my credit card balance in full every month. This way, I do not incur the extremely expensive interest rates applied to credit cards. And credit card interest will always outweigh any benefit you get from points or discounts. So always pay it off in full. Otherwise, you will lose all benefit to any points that you've accumulated. So let's talk credit card interest rates. So here in the UAE, the average credit card interest rate is about 3.99%. It doesn't sound like a lot, right? But 3.99% is a monthly interest rate and equates to almost 50% per year. So if you don't pay your card off in full every month, that balance due is going to grow very, very quickly. So here's a basic example just to show the impact of not paying off your credit card balance. Let's say you owe 20,000 dirhams and the monthly interest rate is 3.99. And you're in a situation where you cannot afford to pay anything off that, but you also don't add to it. So you've cut up your credit card, you're not making purchases with it. The fine for not paying your monthly balance, even the minimum balance, is about 250 dirhams on average per month. So with that, plus the interest, at the end of 12 months, your 20,000 dirhams spend is now costing you 35,738 dirhams. That's an increase of 15,738 in just 12 months. Now, using the same example, if you paid 1,000 per month as an installment against that debt, at the end of 12 months, your debt balance would be 18,245. That's a reduction of just 1,755 despite paying 12,000 in repayments. This is never the best use of your income. So credit cards can be a tool to help your money work for you, but only if you pay the full balance due each month. If you do not, credit cards very quickly can cause expensive, long-term damage to your financial situation and can be extremely stressful. So what about loans? Loans are a common form of consumer debt, specifically personal loans. So they're a type of installment arrangement that give you a fixed amount of money in a lump sum up front, and then you pay it off on a monthly basis. Personal loans are usually issued by banks and credit unions. These loans are different from other installment loans, such as student loans, car loans, and mortgage loans. They are used to fund specific expenses. In this example, your education, to buy a car, or to purchase a home. Whereas personal loans are more generic. It's up to you to use them however you want. And because of that, they are usually unsecured, meaning you don't have to use collateral to secure the loan. Repayment terms are usually ranging from 1 to 10 years. And as I mentioned, you will receive the loan funds all at once in order for you to make, it's normally for a large purchase, and then you begin paying them back immediately within that first month. Your payment will be the same amount every month until your loan is paid off. So it's very easy to predict how much you need to pay every month. And it's a proportion of your principal plus interest charges every month. So bear in mind, you will pay more interest at the beginning and less capital, but as the loan carries on towards the end, that will reverse. They are for fixed terms and provide the benefit of that lump sum of cash if you've not saved enough for what you need. Very common purposes of personal loans are home renovations, debt consolidation, many credit cards being pulled into one debt, wedding expenses, and often vacations. So what are the key benefits of personal loans? Flexibility and versatility. So unlike, for example, a car loan, personal loans can be used for many purposes, such as consolidating debt, as I mentioned earlier, or home renovations. They have lower interest rates. Personal loans carry lower interest rates than credit cards, and so are a cheaper form of debt, and are often used to consolidate more expensive debt into one lower interest-bearing lump sum. There's no collateral involved, so this means unsecured loans don't require collateral for you to get approved. So you don't have to put your car, your home, or another asset up as a guarantee that you'll repay the funds. If you find yourself unable to repay the loan based on the agreed upon terms with your lender, you'll face significant financial consequences. However, you don't have to worry about losing a home, a car, as a direct result. They tend to be easier to manage. So one common reason to take out personal loans, as I mentioned a few times, is to consolidate debt, such as multiple credit card accounts. A personal loan with a single fixed rate monthly payment is easier to manage and predict than several credit cards with different interest rates, payment due dates, and other variables. But please remember, if you use a personal loan to consolidate your credit card debt, cancel all of your credit cards. You need to remove any temptation to use them. Eliminate that risk from your finances. Otherwise, you run the risk of having a personal loan plus new and growing debt on your credit card if you continue to use it. So what are the disadvantages of personal loans? Fees and penalties can be high, so be aware of the fees and penalties associated with your loan. Some have upfront administration fees which cover loan processing, for example, and ensure you understand the total cost before taking out a personal loan. Some lenders charge penalties if you repay your loan early, for example. It can contribute to increasing debt. So personal loans can be a tool for consolidating debt, like I mentioned, but they do not address the cause of the debt. So, like I mentioned earlier, this is a very important point. If you take a personal loan out to consolidate your debt, it will free up your available limit. And for overspenders, this offers an opportunity to rack up more charges than free themselves of debt. So please cancel the credit cards if you're in that situation. So before accepting a personal loan, use a personal loan calculator online to determine whether or not you can afford the monthly payments for the term you'll be paying it off for. It will almost always make more sense to build up your savings to pay for a large service instead of taking out a personal loan and making payments with interest for many years. When comparing personal loans, pay close attention to the details. Specifically, consider the following. What is the interest rate? What are the fees attached? What are the repayment terms? What are the borrowing limits that I have? What is the minimum amount I have to borrow and the maximum? Are there any collateral requirements? And what is the impact going to be on my debt to income ratio? So now let's talk mortgages. A mortgage is a loan taken out to buy property or land. The term can be anything from 10 years to 30, depending on the ages and financial situation of the borrower. The loan is secured against the value of your home or land until it's paid off. So if you can't keep up with your repayments, the lender can repossess and take back your home and sell it so that they can get their money back. Interest rates in mortgages are usually lower than personal loans. And there are two types of mortgages in most locations. You have your fixed and variable. Fixed rates stay the same for a certain amount of time. This can be for a shorter period or for the full term of the mortgage agreement. Variable rates will change based on the market. This means your monthly payment can change based on your interest rate. So now let's talk about strategies to pay off debt. If you currently have debt and you would like to consciously pay it off, here are 4 different ways to approach it to accelerate eliminating debt from your life. Each one has its own merits and benefits. So my advice, as always, is to understand each one, then pick the approach that most resonates with you, the one you find most motivating and makes most sense to your personal financial situation. The first step you need to do is make a list of all your debts. And you need to know the creditor name, the total amount of the debt, monthly payment amount, interest rate, and the due date. Having all of the debts in front of you will allow you to see the bigger picture. It's important to have full clarity on your debt situation to make a good plan for you. Include relevant terms and conditions too on each debt, such as fines and penalties, both for not paying, but also penalties can be applied for early repayment. So revisit this list periodically so you can monitor your debt situation and see the positive impact your payments have made. So next, choose a payoff strategy that works for you. The first one we'll talk about is the snowball method. The snowball method is when you pay the smallest balance of your debt first, working towards the largest balance. To do this, list all of your debts from the smallest to the largest. You then devote extra money each month to paying off the smallest debt first. You make only the minimum payments on the others, and then when the first balance is settled, you move on to the next smallest in your list. Think of it like a tackle the easy jobs first approach. You see, it's not easy to get excited about paying off what you owe, and it's even harder if you don't seem to be making a dent in your debt. So without a sense of progress, it's very common to become prone to throwing in the towel earlier on. The snowball effect can help prevent this, as you will see progress quickly. It's our hunger for instant gratification that makes the snowball effect so effective. However, it is usually more expensive than other methods, as the smallest amount might not be the most expensive debt. Therefore, it's important to bear in mind that when deciding which method is best for you. The second one is the avalanche method. So this method involves making minimum payments on all of your outstanding accounts, then using any of your remaining excess funds and pay it against the debt with the highest interest rate. So using the debt avalanche method will usually save you the most in interest payments. It might not be the fastest, but it tends to be the cheapest way to pay off your debt. The Kiyosaki method. Now this is a method attributed to Robert Kiyosaki, the author of Rich Dad, Poor Dad. This method involves paying off any extra cash that you have to the highest minimum balance payment first. The advantage of this method is it frees up your income quickest, but it may not be the cheapest method of paying off your debt. But if you like to just see that large amount coming back into your income, that's the one for you. Emotional method. So have you ever had a debt you regret, or one that just the thought of it brings up a lump in your stomach? If you have a particular debt that causes you stress, then applying the emotional method may be right for you. In this case, you focus all extra payments on the most emotionally damaging debt first. And very often these are credit cards for something you no longer own or regret. So once you've decided all this, there are some special considerations. If you're applying one of these strategies to credit card balances, it is crucial to stop using the credit card for new purchases. It's very difficult to pay off a balance if you're continuously adding to it. So use cash for purchases instead. So now, at this point, you have done the following. You have an understanding of what a good and versus bad debt is for you. You have clarity and understanding of your debt situation, including the terms and conditions of each debt that you have. You have assessed which payoff approach is best for you. And you will now likely have a clear understanding of your feelings towards having debt. All of that together, you now have a plan in place to become debt-free. Now, how do we stay motivated? Debt repayments are not exciting for most people, and it can be particularly hard to stay motivated as most consumer debt is for stuff we no longer have. So how can we stay motivated and focus on our debt repayments when things get hard? So for long-term debt, set milestones you can celebrate on your way to that debt-free life. So let's say you have a 7-year term on your personal loan. Maybe break it down into milestones, such as when you've paid off 30%, when you've paid off 50%. Then celebrate and reward yourself when you reach each milestone. And this reward can be financial or not, it's up to you. Examples that people do is maybe buy yourself something you've wanted for a long time but didn't purchase as you were focusing all excess cash on debt repayment. Maybe take a Saturday to yourself and sit on a beach and read a book and be completely guilt-free. Have a nice dinner out with friends. Find something that's a benefit to you and have that as your goal. Write it down and do it as soon as you reach your milestone, and be guilt-free about it. Be proud of yourself and just do it. So in summary, debt can be a financial benefit when managed properly and kept to a low debt-to-income ratio. It should not be taken on without much consideration and specific purpose. Credit cards can be a financially beneficial tool, but only when we understand them and use them responsibly. The number one rule is always pay them off in full every month. If you cannot afford to do this, you cannot afford the purchase. So good debt has the potential to increase your net worth or enhance your life in a meaningful way, such as buying a home. But bad debt can ruin your financial life and can take many years to financially recover from. So while an individual's preferences ultimately dictate the amount of debt that you are comfortable with, limiting your debt ratio to a maximum of 30% provides a useful starting point to calculate a reasonable debt load. But I urge you to aim for 0% debt to income ratio, as being debt-free is a major building block towards financial freedom.